Rahul Chadha joins us. Let's connect with him and let's understand that is he the reason why FIs are back? Is he buying? Last time when we spoke to you, said that you plan to invest into India. And I think you're a man of your words. That's what I can say. FIs are back.
Yeah, no, if you remember last time we discussed, and this was the China reopening time, and this was the time when Heidelberg report was there, and our view was we were one of the few ones who were taking some money off China reopening and adding to India, and we wish we could have done more of that. But that's something which worked well over last 3 months. As we talk today, I think some of the valuations in the mid caps particularly are looking stretched. See, the large cap names haven't really participated in this rally last 2-3 month of rally, but I think markets got a bit exuberant over the mid caps, and we've seen with what Fed did today, where though this one is a pause, but I think what they said in terms of um, two more rate cuts for rest of the year and no cut, two more rate hikes for rest of the years and no cuts for 2024. I think that would be a dampener for bulls.
Say that this summer rally of 2023 has now reached the 11th hour, maybe a couple of percentage points, 5-7% here and there, and then we could peak out.
Absolutely, I think we are closer to the peak of this rally.
That's what I think.
What one also has to understand is this rally also started at a time when Fed expanded his balance sheet by close to $500 to $600 billion post this regional banks crisis in the US. And now again, we see Fed's balance sheet is contracting. Look, this doesn't take away from the longer term India story, and something which we've discussed before also. What happens is Indian markets will continue to outperform. But right now, particularly in the mid caps, you don't see much margin of safety.
When you say margin of safety is not there, is it largely because of the view on valuations, or you think earnings will disappoint us?
So I think growth recovery is going to be slower. What you're going to see is gross margin expansion, which comes through because of RM benefits, lower commodity prices. But the revenue momentum is going to be slower. See, we've all seen the slowdown in the economy. There were pockets, some select autos, some QSR companies which were doing well. Banks were an exception to it. But I think the recovery is going to be slow from here. So that is one thing. And valuations also are not cheap, looking at the fact that rates may not go in a hurry.
It's interesting that you say autos, Rahul. Hi, morning, firstly. Because, within every sector, you're seeing some stark divergence. And I can pick up any literally across the board, barring, I think, defense or railways or the other manufacturing themes. But specifically in autos, last year belonged to an M&M and a TVS, and it seems like it's a go for Tata Motors and even underdogs like Hero MotoCorp, for instance, this time around. How are you positioned within autos right now?
So I think what you raised is a fair point. Look, though we kind of put them together as autos, but each of these companies specializes in its own segment. And what we've seen is demand being dominant, particularly for two-wheelers for last couple of years. So that's kind of a coming back. And last year's was this trend of SUVs. It continues to be this year with the end of this chip shortages, etc. So we continue to like names like M&M, Tata Motors, Eicher Motors, etc. And I think these names are still fairly valued compared to some of the other mid caps, which are up 20-30%.
So you have exposure to a lot of auto names, but you also have exposure to the entire new age tech names, the likes of Zomato as well as Nykaa. Are you looking at expanding your portfolio there, deepening your presence?
Look, again, we're happy with what we have over there. Zomato is a name we've liked for a while, and there were good entry points where we increased the exposure over there. I think things are still a bit slow, but look, these names have done a great job in terms of, particularly for Zomato, in terms of gaining market share, and as and when the demand recovery happens, we expect them to bounce back strongly.
What's the contra play in this market, or is there any?
Contra plays would be something like pharma names. What one is picking up from ground, particularly in the US, is that look, there's different tightness in this pharmaceutical market. The pricing has improved considerably for these generic pharmaceutical drugs as some of these companies withdrew or move out of the market. So I think that is a space which has not done much for last 2-3 years. We've continued to like hospitals over pharma, but this may be the time for some of these generic pharma names.
So you have been liking the hospital names. You do have the likes of Fortis as well as Narayana Healthcare in your portfolio. Is it time now to book some profits and churn the portfolio a bit, or you're happy with the names that you have?
So if you have a 3-5 year perspective, again, continue to hold on to the names. But I would be reluctant to add these names at these levels. I mean, they've done exceptionally well in recent times. Valuations are not in favor. So some cooling off is warranted for these names.
Okay, and what about the entire hospitality segment, the entire urban consumption theme? You did play through the hotels route, but I want to expand it to, let's say, the likes of QSR as well. Maybe PVR, Inox, Phoenix Mills. Any other way you're looking to play the urban discretionary spends?
So in the QSR, a name we've held for, I think, last 4 to 5 years is Westlife. I mean, that name's positively surprised us in terms of the strong value proposition they've offered to the consumer and how they've stood out in terms of the delivery in the QSR space when the rest of their peer set has struggled. Continue to back that name. But yeah, one would be looking at other QSR names, companies of the and like Juby, etc., which are great companies, but are going through this temporary period of slowdown. And I think next couple of quarters would offer good entry points for these names.
Rahul, let's understand the risk on the horizon. Monsoons are not great. Interest rates would move higher. A lot of consumer stocks are trading at P multiples of 50 plus. A lot of defense stocks are trading at valuations of consumer stocks. And a lot of railway stocks have started commanding P multiples of I just don't know what to use as a comparison because they are even higher than consumer stocks now. And there's nothing more higher than consumer stocks.
So I think what you've said, Dekunj, is a fair point. And look, that's why there are no compulsions to be in the market at this point of time. And which is what I'm saying, that look, if you're looking to deploy fresh new money, again, might as well wait. What we've got to also understand is the setup we are in. And this is kind of a quasi-stagflationary setup where the gains you'll get is 20-30%, etc. at most. And then one has to wait for better entry points for one to make money. I think where you get value here in the market is something like a Reliance, something like, again, financials. The large cap banks haven't really participated in this rally. And that's where it kind of helps them if inflation slightly cools off. So I think that's where it's positive. For a contrarian, IT is also attractive. See, those names may go down 10-15%, but from a 3-year perspective, we've seen these companies are great compounding machines and they're going to make money for investors.
Pure metals. China is back. Chinese interest rates are going down. The Chinese government is conscious of the fact that tightening is not going to help them, but supporting the economy is something where they need to desperately move. What are the chances that second half China turnaround is stronger than what markets were anticipating, and that could be a booster for metals?
Okay. So again, right now our view is that look, China is somewhat in a deflationary trap, but look, within this structural challenges which China faces, they can be cyclical rallies, and we've seen should government be seized of this risk, which increasingly the sound bites in last couple of weeks are coming through. It may happen that they will extend a fair bit of a stimulus on the housing market. They're already doing on the EV space. There is talk that they may do that on the industrial policy front. If they do with the restructuring of local government debt, that may be positive in terms of boosting the markets. And that may lead to an uptick in metals. But then see, what one's got to keep in mind is that look, this recovery probably lasts for 6-9 months, and then again the same set of challenges face China. What we look to play China is as a more of a cyclical market, where we're looking at India a structural market. But even in a structural market like India, one wants the comfort of valuations, at least some reasonable valuations, or some of these risk factor of a slower recovery baked in. Before meaningfully adding positions, which is why situations like when it happened with the Heidenberg report early this year were great entry points for the Indian markets.
You will wait for the next crisis. Otherwise you will not buy.
Again, wait for crisis, wait for time corrections, look for good franchises, the likes of HDFC Group or ICICI Bank, which have not done much over last 6-9 months, and I think those are attractive entry points. So I think one's got to be somewhere disciplined about valuations when allocating fresh money.
Or, when markets go higher, the interest is always high. That's human nature, right? When the market starts doing well, you always want to be in that market. FIs were selling last year, and now that markets are doing well, I'm sure they would be tempted to come back. What are you telling your clients who are telling you, Rahul, we wanted to invest, but we were reluctant. Now we are convinced we want to go to India. Here's our commitment. Why don't you go and invest? Are you accepting fresh flows? Are you telling them to wait it out?
Okay, so our message to investors like that is, look, in a market like India, it always pays to come when there are bouts of skepticism, when there is some pessimism, because then you have valuations on your side. What we invite them to put money is in the Asia fund, where we as the managers have the flexibility to move within markets. I mean, look, China we can say has structural issues, but there are other interesting opportunities in markets like Korea or parts of ASEAN, etc. And that's where valuations are much more attractive compared to India, and that's where money can move. So I think coming in a regional fund gives that flexibility for a manager to move across markets where you may have structural opportunities, but comfort of the valuations also.
Rahul, how are you looking to play the entire industrials and capex theme, if at all? Because I don't see much exposure there. Maybe you have a capacity infra in one of the funds, but not a whole lot of exposure to industrials or capex.
Okay, so we've got exposure to the likes of ABBs, Siemens, etc., and we've held them, ABB particularly for last 3 years. So that's done reasonably well. Continue to like that space. I think the challenge one is facing is the valuations. And look, now you can see quite a many pockets of fair valuation names which aren't really cheap in the portfolio. So one understands for these industrials that, look, they're still in the early stage of their growth cycle. This is hopefully a super cycle which is into a making, started by government's capex and then followed on by the private sector capex. So we continue to like these names. But again, should there be a pullback in market, should the growth recovery kind of take a while, won't be surprised if these names are down 10-15% before resuming their longer term structural uptrend.
Not extending that list to the manufacturing theme, not impressed with the likes of, the Keynes, Dixon, Amber of the world?
I think those names been taking a breather for last couple of years. What happened is some of their end customers were setting up manufacturing bases in the country, and that's where they got impacted. But having gone through a period of time correction for last 2 odd years, those names look interesting. So probably in this pullback that happens in the coming quarter, one would look to add to some of the names.
Interesting. Rahul, always good to have you on the show. Thank you so much for taking the time out.
Thanks for having me.